Hey, fellow investors, have you ever wondered how to spot potential red flags in a company's financial statements before making an investment decision? Well, you're in luck because today we're diving into the crucial topic of 6 red flags to watch for in a company's financial statements. This knowledge can help you avoid risky investments and protect your hard-earned money. Let's start with a question. Why is it important to scrutinize a company's financial statements? The answer is simple. These documents provide a window into a company's financial health and can reveal potential issues that might not be immediately apparent. By learning to identify these red flags, you can make more informed investment decisions and potentially avoid costly mistakes. Now, let's explore the 6 key red flags you should be on the lookout for when analyzing a company's financial statements. First up, we have consistently declining revenue or earnings. This is often one of the most obvious signs that a company might be in trouble. When I'm looking at a company's financial reports, I always pay close attention to the revenue and earnings trends over time. If I see a pattern of decline quarter after quarter or year after year, it raises a big red flag for me. For example, let's consider a hypothetical tech company called TechGrow Inc. If TechGrow's revenue has been decreasing by 5% each quarter for the past 2 years, that's a clear sign of trouble. It could indicate that the company is losing market share, facing increased competition, or that its products are becoming obsolete. The second red flag to watch out for is a high and growing debt-to-equity ratio. This ratio tells us how much of a company's financing comes from debt versus equity. A high ratio suggests that a company is taking on too much debt, which can be risky, especially if interest rates rise or if the company's cash flow decreases. I remember analyzing a retail company a few years ago that had a debt-to-equity ratio that kept climbing year after year. It started at 1.5, then went to 2.0, then 2.5, and so on. This was a clear warning sign, and sure enough, the company eventually filed for bankruptcy because it couldn't keep up with its debt payments. The third red flag is negative free cash flow over multiple periods. Free cash flow is the money a company has left over after paying for its operating expenses and capital expenditures. It's essentially the cash that a company can use to pay dividends, buy back stock, or reinvest in the business. When I see a company with negative free cash flow for several quarters or years in a row, it tells me that the company is spending more than it's bringing in. This isn't always a deal breaker, especially for young, growing companies, but it's definitely something to keep an eye on. If a mature company is consistently burning through cash, it might be heading for trouble. The fourth red flag involves unusual accounting practices. This one can be a bit trickier to spot, but it's crucial to watch out for. One common red flag is aggressive revenue recognition, where a company records revenue before it has actually been earned. I once came across a software company that was recognizing revenue for multi-year contracts up front, instead of spreading it out over the life of the contract. This made their current year's revenue look great, but it was misleading because they were essentially borrowing from future years' revenue. Always be skeptical of accounting practices that seem to inflate current results at the expense of future periods. The fifth red flag is poor or declining profit margins. Profit margins tell us how much of each dollar of revenue a company keeps as profit. If I see a company's profit margins shrinking over time, it could indicate that the company is facing increased competition, rising costs, or pricing pressure. For instance, imagine a smartphone manufacturer that used to have a gross profit margin of 40%, but over the past few years, it's dropped to 30%, then 25%, and now it's at 20%. This trend would definitely catch my attention and make me want to dig deeper to understand why the company is becoming less profitable. The sixth and final red flag we'll discuss today is frequent changes in leadership or management. While some turnover is normal, frequent changes at the top can be a sign of instability or underlying problems within the company. I remember a case where a tech startup went through 3 CEOs in just 2 years. Each time a new CEO came in, they changed the company's strategy and direction. This lack of consistent leadership ultimately led to the company's downfall. When I see frequent management changes now, it always makes me pause and investigate further. Now, You might be wondering how to keep track of all these red flags. One tool I find incredibly useful is a financial report tracker. These tools can help you monitor key financial metrics over time and alert you to any significant changes or trends. There are many options available, from simple spreadsheets to sophisticated software platforms. Remember, these red flags don't necessarily mean a company is doomed, but they should prompt you to dig deeper and ask more questions. Always look at the bigger picture and consider the context of the industry and overall economic conditions. In conclusion, by keeping an eye out for these 6 red flags, declining revenue or earnings, high debt-to-equity ratios, negative free cash flow, unusual accounting practices, declining profit margins, and frequent leadership changes, you'll be better equipped to spot potential issues in a company's financial statements. This knowledge can help you make more informed investment decisions and potentially avoid costly mistakes. If you found this information helpful, please don't forget to like this video and subscribe to our channel for more investing tips and insights. Share your thoughts in the comments below. Have you ever spotted any of these red flags in your own investment research? And don't forget to hit that notification bell so you never miss our latest uploads. Until next time, happy investing.